In today's episode, we're going to look at 10 myths about growing your investments. Welcome to episode 4 of the Financial Coach podcast. My name is Mark Corkery and I'm the Financial Coach. The third area of the financial success path is growing your money. So today, I'm looking at some of the ideas that Warren Buffett illustrated throughout his career as an investment manager. Warren Buffett is as much an experienced investor than anybody else. However, we can all learn some valuable lessons from his experiences. First thing we look at are common myths about investing. Myth 1. Anyone can make a killing by investing in the stock market. First, let's address the most common investor myth. Trading for a living is a contradiction in terms because most traders don't have much of a life. They're all staring at computer screens every day, trying to figure out if it's a green day or a red day. In the short term, it's possible and easy, but no member of the Forbes 400 rich list became rich from trading. Traders do not generally sleep well because their opportunity for profit comes by the action or inactions of other market participants, whereas conservative investors sleep well because they've looked inside the business and have a margin of safety. Myth 2. Initial public offerings, also known as IPOs, are great investments if you can get in on the actual IPO. It's the best way to buy a new share as early as possible. Well, the reality is that new stock issues come out at the most favorable time for the promoters. So instead of buying early, do what Buffett and company does, buy an OPO, otherwise known as old public offerings like Coke. Great wealth does not flow to those who were early in investment, but rather to those who saw the long-term value of the investment. Myth 3. Your age should predict your amount of fixed investments. For example, the myth says that a 42-year-old should invest 42% of his assets in fixed income investments. However, the danger of fixed income investments like bonds is that when interest rates rise, the value of the bond falls. A 1% rise in interest rates lowers the value of long-term bonds by 10%. The simple truth is that wealth has been created and enjoyed by those who own a business either directly or indirectly, in whole or in part through the stock market. Myth 4. Investing is complicated. Investing is simple, but it's not easy. How can it be easy? You have to read and research public documents, read corporate annual reports, and listen to quarterly management conference calls to gauge the qualitative aspects of potential investments. You have to phone investor relations departments of companies that you are considering. There wasn't anything terribly complicated about investing in dairy cream for Warren Buffett because he recognized the value. He thought they had competent and honest managers and bought the business at a discount. Myth 5. There's no point in investing if you don't have any money. Well, the story of Warren Buffett shows that a kid with $100 can create billions by applying his principles and practical methods. Many great fortunes have been created by individuals who started with very little money. Oftentimes, the lack of money provides the desire and passion to create and recognize opportunity. Myth 6. Bank accounts are excellent investments. This isn't true if you consider taxes and inflation. Like Warren, you need to save before you can invest, but there just isn't anyone who has created great fortunes by relying on savings accounts. Banks are great for short-term emergencies, but not for building long-term wealth. Myth number 7. You should follow your investments daily. This action will get you into trouble, and it labels you as an emotional investor. It's kind of like getting on the scale every hour when you're trying to lose weight. All investments take time to realize their full potential. Just ask people what was their great investment, and they will tell you it's something they've done for a long time. You're not going to get a great education in a few days or months or even years. Education takes decades. So does the development of your wealth. Myth number 8. Market timing works. You can determine the top of the market and sell and wait for the bottom and buy. This isn't possible. People who get in and out of business ownership so quickly don't understand business ownership. Instead, buy businesses that you can understand with honest management at an attractive price, determined by the present value of all their future earnings. Myth number 9. Rich people at large institutions have enormous advantage over average investors. Although Warren has the advantage of seeing many deals first and used the cash from his ever-expanding empire to purchase more business, smaller investors have the advantage of size or the lack of size. You see, the greater the wealth, the greater the anchor against superior returns. A small investor armed with proper training and principles can move into a wide variety of investments without notice or disruption. A small investment portfolio can attain greater returns than the same smart investment of a large portfolio. Myth number 10. Investing in stocks is like gambling. It can be if you're a speculator. You're gambling if you don't know what you want. Betting on stock requires little skill, but investing ever-increasing sums of money wisely takes skill, knowledge, patience, and hard work. So all of the myths above are common beliefs of Warren Buffett. You can look at them and try to apply some of them to your own investments. Before I wrap up, I just want to discuss my first 7-day financial base camp challenge, which I held this week. We had a great take-up on the challenge, and I was delighted with the response of the participants. I'll be holding another challenge again in September. So until the next episode, thanks for listening.